Welcome to our show. Listen, today I'm going to talk about the fourth quarter last year and some economic fundamentals that you're going to want to know about, so stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
All right, folks, we have been 10 years, 9 months now into this bull market. Now remember, it bottomed out in the March of 2009, and now we've been in a bull run ever since. Now the definition of a bull run is when you haven't had 2 quarters in a row of negative GDP growth, and we haven't had that for now almost 11 years. Now it's also what causes people to get a little bit nervous, because when the market's been good for so long, surely the shoe is going to drop, right? And a lot of people recall that 2008 market crash, or they recall the one in 2000 through 2002 where both lost half their value. So when it's been good for quite some time, this is when people start to get a little bit nervous. You can look at all the major indexes here. You can see in 2018 wasn't a very good year for pretty much all asset classes. But you look at 19, you couldn't have gone wrong. S&P 500 up about 29%. You got the Dow up 22%. You got the NASDAQ up 35%. Now this can be a little bit deceiving, as I'm going to show you in this next chart, because if you look at the S&P 500 the last 2 years, for pretty much all of 18 and a good part of 19, it was pretty much flat. You can see a lot of volatility and it didn't get anywhere. And then all of a sudden, the last 3 months of last year, we've seen this market surge. You know, I would dare say what was called a little bit euphoric, because the earnings haven't necessarily been there. But the market hit new highs 26 times. So, you know, again, this is something we're going to watch, we're going to be concerned about, because everything is about earnings. And if the earnings aren't following this market up, then, you know, if they don't come up, the market's going to have to come down to meet them. So something we're going to want to be paying much attention to. This is the S&P 500 versus everybody else, is the best way to put it. And you got to understand, our markets pretty much run in tandem with everybody else. We are much more globally connected than we realize. So when we see it in tandem, and you look at this of recent months, it's starting to separate. Growth overseas has been a little bit slower. Ours has been doing well. So again, almost like earnings, 2 things have to happen. Either our markets are going to come down to meet theirs, or theirs are going to have to come up to meet ours. And I'm not seeing any signs of real huge recovery overseas. So I dare say we're going to be wanting to pay attention to this. GDP growth, you know, the second estimate came out for the fourth quarter and it ended up being 2.3%. So growth is slowing. It looks like it's probably going to hit a little over 2% for the year. We're certainly not it's not indicative of a recession right now, but slowing. So we want to pay attention. And folks, this is something that, you know, I might interject. You know, when we're seeing a slowing economy overseas and in our own economy, you know, we want to be careful, because slow growth, it means earnings are going to be hurt. And when you have earnings hurt, when corporations aren't making as much, then like I said, the market's going to have to adjust accordingly. So, you know, I know a lot of corporations out there are adjusting their earnings reports. You know, they're starting to lower them, because they don't like to come out every quarter and be below expectations. They want to be above expectations. So corporations have been lowering their earnings expectations, something we're going to want to definitely pay attention to. Unemployment rate, it's at basically the lowest it's been since 1969. I think it's settling around 3.5% right now. That's phenomenal. You know, people are working. Now, one thing though that's scratching everybody's heads is, typically when you've seen unemployment be as low as it is right now, you've seen inflationary concerns, and we're not seeing that. And I think a lot of this, and I've talked about this in prior market updates, is historically in the past, when we've had such low unemployment, that what companies would do is they had to pay people more to get them to work for them. So when the labor market was really tight, wages would start to rise. Now, when wages start to rise at significant levels, that causes inflation, because there's increased demand for goods and services because people have more money, but there's lower supply, so you start to see, inflation concerns. We're not seeing that now. Wage growth hasn't been that phenomenal. What we're finding companies are doing is they're finding ways to innovate by using technology. So we want to watch this. It's a good thing if we have low unemployment because people are working and if they're confident they're going to be spending, but we're going to want to be paying attention. So stay tuned because we're going to be talking more about these fundamentals. And by the way, if you're somebody that wants to make sure you're positioned right, how these fundamentals affect you and your portfolio, then give us a call.
Every success story starts with a plan. The success of your retirement depends on a solid financial plan. If you are nearing retirement or already retired, we invite you to an informative live event to help you plan to retire well. There is no cost and no obligation, and dinner is on us. We are Centennial Wealth Advisory, financial professionals, specializing in retirement planning and serving all of Northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. Our presentation includes highlights of the Tax Cuts and Jobs Act of 2017 and the big opportunity it presents over the next 7 years. The surviving spouse tax trap, how can you avoid it? How two similar portfolios can end up with two drastically different results. What's the definition of a bull market? Do you know your risk exposure? And much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, March 10th at Boone's Long Lake Inn in Traverse City. Thursday, March 12th at Lakeside Charlie's in Cadillac. Or Tuesday, March 17th at Big Buck Brewery in Gaylord. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow. But seating is limited and tends to fill quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event to help you plan to retire well. Call 888-608-5825 today.
If you're retired or approaching retirement in the next 5 to 10 years, join us for an informative live event. This event is all about you, the challenges you face, and the information you need to help you build the future that you want. There's no pressure to become a client. Our goal is simply to give you valuable information that you can use to make smarter financial decisions. We hope that by the time you leave this event, you'll be one step closer to your retirement goals. Welcome back. Now, if you're just joining us, I'm talking about the fourth quarter last year market fundamentals. Now, in the last segment, I was talking about unemployment, how it's been the lowest it's been since 1969. This is a good thing, right? I mean, if more people are working, that means there's more people spending. You got to understand, 70% of our GDP is basically consumer spending. So if people have more money in their pockets, they're spending more. That's good for corporate earnings. That's good for the market overall. So that's a good thing. A lot of people, though, don't trust those low unemployment numbers. They always want to go to what we call the labor participation rate. You know, what that is people entering the workforce. Okay, it used to be said that when we had lower unemployment numbers, well, that doesn't count the people that are at work, and that doesn't count the people that have given up on the job market. But what this chart shows is that there's actually been increased participation. You're finding people getting off the couches and going to work because the market is good. There is some good jobs out there. So that's something you want to definitely pay attention to. This is new single-family houses sold in the United States. You can see that since the last recession, this has been very much on the rise. This has been a very bright point in our economy, because when houses are being sold and values are going up, people have more equity in their homes, and when they have more equity in their homes and maybe their 401k is doing well, then they feel more free to spend the money that they're making. And again, consumer spending is a big part of our economy. This is a median sales prices a house is sold in the United States. Now, it has also been on the rise since the last recession, but you can see that in recent years, that's starting to flatten out a little bit. You know, prices aren't going up as fast as they were. Matter of fact, there's been a little bit of volatility with that. I would dare say in recent months, it's mostly been because of the interest rates. You know, the Feds were starting to raise the interest rates, and then you're seeing things slow down in the real estate market. But then as soon as the Feds went back on the interest rates, now it's kind of fueling the real estate market again. Inflation, talked about this earlier. You know, the Federal Reserve would like to, keep this right around 2%. You have to understand they have a dual mandate. They want to keep unemployment low. Well, we can't argue that's not the lowest it's been in a long time. And they want to keep inflation right around 2%. And it's been basically that for quite some time. This has really caused the Feds to scratch their heads because, as I was talking about earlier, most typically when you've had, unemployment be so low, you'd see wages dramatically increase, which causes increased demand for goods and services. And when there's not enough supply, that causes the prices to rise, and then thus you get inflation. But we haven't had that in this recovery. It seems like with this low unemployment, that old Phillips curve that they used to call it, which showed that relationship, just isn't there anymore. The Federal Reserve, I can't talk enough about the Federal Reserve. They play such a huge role right now in our economy. You have to understand, since the last recession, they went from a balance sheet of $1 trillion, meaning the amount of money that they had, loaned out, and during that, 9-10 year period, basically raised their balance sheet to $4.5 trillion. Now, that's a lot of money they basically pumped into the economy with those last 3 quantitative easing programs. The other thing they did is they lowered the interest rate down to 0.25%, and then they left it there for about 8-9 years. And then about 3 years ago, they wanted to start what they call normalizing things, okay? They know another recession's coming because they understand markets are cyclical. You'll have periods of expansion followed by periods of contraction. So when things typically heat up kind of like they are, we should expect some contraction sooner or later. Well, they want to normalize things because when we do get to that next contraction or that next recession, again, they want to have a handle to pull. Well, if they have interest rates be so low and all the money they can print out there, what do? So what they started doing about 3 years ago is they started lowering that balance sheet. They went from $4.5 trillion to $3.8 trillion, I believe it was. And they took their interest rates at 1/4 point and raised it up to about 2.5%. And in the fourth quarter of 2018, the markets had a fit, okay? And then the Federal Reserve quickly reversed course, all right? They started putting more money into the economy, and they basically started lowering rates. They basically lowered them 3 times, the third one being in October here of last year. Now it's at 1.75%. So I'll talk a little bit more about this in the next segment, but this is something that we definitely want to be paying attention to.
We look forward to helping you plan to retire well.
Every success story starts with a plan. The success of your retirement depends on a solid financial plan. If you are nearing retirement or already retired, we invite you to an informative live event to help you plan to retire well. There is no cost and no obligation, and dinner is on us. We are Centennial Wealth Advisory, financial professionals, specializing in retirement planning and serving all of Northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. Our presentation includes highlights of the Tax Cuts and Job Act of 2017 and the big opportunity it presents over the next 7 years. The surviving spouse tax trap, how can you avoid it? How two similar portfolios can end up with two drastically different results. What's the definition of a bull market? Do you know your risk exposure? And much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, March 10th at Boone's Long Lake Inn in Traverse City. Thursday, March 12th at Lakeside Charlie's in Cadillac. Or Tuesday, March 17th at Big Buck Brewery in Gaylord. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow. But seating is limited and tends to fill quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event to help you plan to retire well. Call 888-608-5825 today.
Hi, welcome back. Now, if you're just joining us, I'm talking about the fourth quarter 2019 market fundamentals. Folks, we want to talk about these market fundamentals because we want to look at all the things that are going to affect earnings. You know, a lot of people think the market is gambling. You know, they understand it goes up over time, it has some volatility, but they really don't understand the truly the things that actually drive the market up. Folks, it's not brain surgery. It really comes down to earnings. You know, the market trades at a multiple of those earnings. So historically, it's traded at just under 17 times earnings. So as long as corporate earnings are growing, you're going to see the market for the most part grow. Where you want to be concerned is when the market is shooting way up and earnings aren't following. Or that multiple of earnings gets too high. You know, when it starts getting 20 times earnings or more, you know, the concern is how is that going to be sustainable for a long period of time? Now, a lot of people will try to get ahead of news because if they see some good news in the market, there's some things they think might affect earnings or drive those earnings up, then they want to get ahead of it by getting into the market soon. But sometimes that can be just an emotional reaction. So paying attention to market fundamentals to make sure that things are solid, that earnings are going to be strong and growing is very, very important to know. Now, in the last segment, I was talking about the Federal Reserve and what a huge role they play. You know, that one of the functions of the Federal Reserve is to act like a bank to the banks, you know, to make sure that there's market liquidity. If you ever see at Christmas time that movie, It's a Wonderful Life, George Bailey, played by James Stewart, you know, what happened when all the people went to the credit union all wanting their money all at once, right? And he had to explain to everybody, listen, your money, Jill, is with Joe, and Joe, your money is with Stan, and you know, I don't have your money sitting in the bank, so I can give you some of it, right? The Federal Reserve is the one that kind of acts, you know, gives all the banks the liquidity so there can't be a run on the banks accordingly. But they're also very effective in trying to spur on the economy and slow it down when they need to. And the way they do that is through selling securities and buying securities and interest rates and the money supply that's out there. So understanding what the Federal Reserve is going to do, you'll see markets react very quickly to anything they do because they play such a big role. So we're going to want to pay attention. I'm real concerned about the Federal Reserve, as I talked about in the last segment, because when they started to normalize things and it didn't, and the markets had a fit, what are we going to do when we get to the next recession? That's what we're going to worry about. U.S. wages and salaries growth, you can see that, you know, again, I talked about this in earlier segments. This hasn't been growing as fast as we typically see with such low unemployment numbers, but it has been on the rise. It has been growing at a faster pace than inflation, so that is a good thing. This is just the U.S. dollar index. Since 1973, they took our currency and they compared it with all the other major world currencies, and they baselined it at 100. And then they just basically been tracking it ever since. So right now, at the end of the quarter, it was 96.85. Basically, the dollar is strong relevant to the other currencies. The only drawback to that is when our currency is strong, it makes our exports more costly, which hurts our manufacturing. That's why you'll see countries all the time manipulating their currency, because they're trying to lower it so they can have their import or their exports be cheaper. So, and then that gives them more of a competitive edge. But right now, the dollar is strong. It's something that I always like to see. What I would like to see is a strong currency with strong manufacturing. U.S. consumer sentiment. If there's anything holding up this economy right now, it's consumers' confidence right now. It's at an all-time high. People, again, I think it's because they're working. So wages are going up. When they're feeling good about the economy, they want to spend. And when they want to spend, that's good, like I said, for corporation earnings, that's good for the market as a whole. But you got to be concerned, because when consumer sentiment starts to wane, which we're starting to see it kind of flatten out, that's where you want to be concerned, because when consumer sentiment goes the other way, that can be a bad thing. So something we're going to want to continue to watch. Stay tuned. And again, if you're somebody that's got a portfolio out there and you just want to know how you're positioned to make sure you're positioned appropriately with the market that we're in right now, then give us a call.
If you are retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and to educate. Simply attend one of our live events or schedule a meeting at one of our Northern Michigan office locations for a free, no-obligation retirement review.
When you look at your IRA statement or you're looking at your 401k statement, is it all yours? Think about it, because this is money that's never been taxed. Now every dollar you take out, who's there to take their share? Uncle Sam, right? Maybe in some cases, state of Michigan. You have a partner in that account. So what's your strategy to get that partner out of your account? Listen, here at Centennial Wealth, we take that opportunity to look at your scenario, look at the different ways you're going to be taking money out of those accounts, and try to find the cheapest way possible to buy out Uncle Sam or State of Michigan out of those accounts. See, in a lot of cases, when you get into retirement, you're dropping into a lower tax bracket. That is a great opportunity to be moving monies possibly from an IRA into a Roth IRA, because what are you doing? You're buying out Uncle Sam at the lowest rate possible. We have to be careful, because anytime we're dealing in retirement and we're taking income, we have to look at how that income is going to be taxed. So we want to be very cognizant of what that tax liability is going to be, so we can minimize taxes at the highest level. So I encourage you, give us a call. We'd be glad to sit down with you, see if maybe you're a Roth IRA candidate, maybe even talk to you about what might be the best IRA exit strategy for you.
Are you retired or approaching retirement in the next 5 to 10 years? Join the Centennial Wealth Advisory team for an exciting presentation with complimentary gourmet dinner and learn essential financial strategies for a comfortable retirement. 3 dates and locations to choose from. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Call 888-608-5825.
Welcome back. Now, if you're just joining us, I'm giving a fourth quarter market update of last year, and I'm talking about market fundamentals. Now, folks, I can't say it enough. I talked about the last segment. Consumer confidence is holding the economy up right now. But I just want you to see in this chart, this is a little bit concerning, because what you see in the orange line is CEO confidence. All right, this is, CEOs in charge of these large corporations. Their confidence level is going down, while consumer confidence is going up. What's this say? Do they know something ahead of us? I don't know, but it's something we're going to want to pay attention to, because every time we've had this kind of a gap before, usually recession is followed just soon thereafter. So something to pay attention to. Small business confidence, you can see in this chart, it's at historic highs. Why is small business confidence such an important part? Because you got consumer confidence, which makes up about 70% of our GDP, but small business confidence makes up another 17%. So between consumers and small business sentiment, if they're all feeling positive, well, that's 87% of our GDP. That means things are, they're spending. U.S. manufacturing, you can see that it's been on the decline. Many will say we've been in a manufacturing recession of recent, most likely because of the trade wars that we've had with China and everybody else. I would like to hope to see maybe that get a little bit better with a possible deal here soon. But it's been in, not necessarily in contraction territory, but getting very close to it. Non-manufacturing, same thing, has been kind of on the decline of recent, not in contraction mode, but something we're going to want to pay attention to. This is just the S&P 500 PE ratio the last 5 years. This is, again, getting back to that earnings. It's a market trading at a multiple of the earnings. So they look at the divisible number. Okay, historically that's always been about 17 times earnings. You can see based on this chart, it's been kind of on the rise. So earnings either got to go up or our market values got to go down to get those back to where they've been normally. U.S. corporate profits, again, if earnings are good, market's going to be going good. And you can see the last 2 years, profits have been on the rise. That's why you've seen the market do well. But this is market forecast. I showed this last quarter. I'm seeing it this quarter. Last quarter, I was seeing a flattening out. Now I'm seeing a possible downturn in corporate earnings, or what they're forecasting. Again, that's a concern, because if earnings are not on the rise, this market's not going to be sustainable. You're going to see it adjust accordingly. This is just the S&P 500 corporate profits after tax. Folks, if there's any chart that tells the story more, it's simply this one, and why you want to be positioned appropriately in your portfolio. That orange line is corporate profits after tax. The blue line is the S&P 500. Now look at the gap. You can see earnings are flattening out, but the market is shooting up. That's not sustainable. Again, earnings got to either rise or the market's going to have to adjust down accordingly. So this is just a huge risk right now. I would dare say I think the market valuations are probably on the high side. And if you're somebody that's worried about risk, give us a call. We can see how you're positioned accordingly. This is just the VIX rate, or what they call the volatility index, over the last year. Historically, it's been right around 20. All that means is what they think the market's going to do to the good or bad, 20% to the good or 20% to the bad. Right now, the VIX rate at the end of the year was at 12. What that's relating to is less volatility. When it gets this low, what we have happening is complacency. Why is complacency a bad thing? Because when people are feeling like the markets, they're not worried about the risk, that's usually when things start to happen. Because then when they see some negative bad news, they'll usually react a little more differently to it. Yield curve, you heard this a lot about this in the news. When there's been a flattening out of the yield curve, meaning the long-term treasury rate and the short-term treasury rate start coming together. Now, isn't that crazy? Why would somebody give the government 30 years for the same amount they'll give them for 5 years? But when that happens, that's usually been an early indicator of a recession coming in about a year and a half. Right now, we don't have that inversion, and by what the Feds have been doing, they've kind of averted that. This is a 10-year versus a 2-year, same thing, no inversion, but something we're going to be wanting to pay attention to. Again, folks, if you're somebody out there, I hope that you found this valuable. If you've got a portfolio, you want to see how you're positioned, then give us a call and we'll gladly make sure that you're positioned appropriately.